Hello and welcome to episode 26. In this week's episode, we find out who won the battle between Pernod Ricard and Expedia. We have a look at our portfolios and see how they have performed over the last week. And finally, because we're celebrating the Battle Royale hitting a 10% return, our theme this week is finding the best 10% yielding but safe dividend companies. Without further delay, let's get underway. Every week we invest £25 into each portfolio. One portfolio where you select the stocks, one that tracks the market, and one that generates income to pay to you. We'll then invest an extra £1 into each portfolio for every 100 subscribers we get. We've had some clear winners recently, and with 3 votes to none, this week was no exception. It seems that the drink stocks, as opposed to getting drunk, are getting sunk, because this week the winner was Expedia.
3, 2, 1, go.
So last week, if you'll remember, the markets were pretty flat, and that was the case in our portfolios as well. The benchmark actually fell by 0.1%, and pleasingly, both our income generator and Battle Royale were up, albeit a tiny amount of 0.3. However, all that being said, I wish it was still the case, because this week the markets have been pretty flat, but our portfolios have managed to perform quite badly, I would say. The income generator, the best performer, up 0.1%, the benchmark down 0.5%, and the Battle Royale, I think this has been its worst performing week to date, certainly compared against the benchmark. It's down a whopping 2.6%, and the benchmark only down 0.5%. We're going to have to keep an eye on that one. Our list of biggest movers in the portfolios explains why we have that underperformance compared to the benchmark. If you look at the bottom 3 there, B&M, On the Beach and Reddit all falling a fair amount. Reddit going down a whopping 15.3%. And if you take a look at B&M, it's fallen another 7.7%, and over the whole year, it's fallen 40.9%. That is painful. We had 3 nice performers pulling us up a little bit. YouGov Money Group and Mondelez International, roughly around the 6 to 7% increase mark, which is lovely, but not enough to counter those massive red drops from the others. According to Simply Wall Street, we matched the market, and one of our stocks is up 7.3%. I see they like to focus on the positives, which is great. Coming up this week, Money Group, Money Supermarket, has got its earnings report, and the earnings per share exceeds analysts' expectations, so that's why that one jumped up a little bit. Earnings were released on Saturday for Berkshire Hathaway. Warren Buffett has written his annual report to the shareholders, and if you have a read through that, it makes fantastic reading. So good for all of us beginner investors, and I think every investor to learn, and you will definitely you'll definitely learn something whenever you read it. I did. It was fantastic. And then finally some ex-dividend dates for some of our stocks coming up, which is always nice to see. Looking at the Battle Royale in a tiny bit more detail, Simply Wall Street still thinks it's a value portfolio with a solid track record, which is great after its poor performance last week. I'm glad to still see that they think it's got a solid track record and is good value. As you can see, dropped the 2.5%. Looking at the total value overall, Tesla still leading the way, although its total return is now 55%, when at one point that was 100, which was just insane. On the Beach still doing exceedingly well as well. The one I did want to highlight, our latest edition from last week, Procter & Gamble, that went up 4.5% during the week. Unfortunately, I added it in on Monday, so lost 0.1%, but great to see that one already contributing to the portfolio. If we scroll down to the bottom, this is why we've had such bad performance over the last week. B&M, another 7.7, which cost us 30%, which is insane. Tate & Lyle, I was so excited about that stock. I thought that was a really good one, but that is down 26.7%. Again, we're long-term holders with these, so we're not too worried. We want to hold them forever, and I'm sure a company as good as Tate & Lyle will bounce back. Renew Holdings, I think that was a bit of a punt. That's definitely not paying off. But as I say, Tate & Lyle, hopefully one for the long term. B&M, I thought that was the case. Let's see what happens with that. Losing confidence in that one. Not that we're going to sell, but just not as confident that it's going to bounce back. Black Rifle Coffee, is it a hype stock? It's costing us 20% at the moment. We're going to hold it and just see what happens. But a lot of red, a lot of poor performance on the whole. However, we're still up overall. 7.8%. So not panicking and just enjoying the ups and downs of the market and investing. We now have 24 holdings and 13 of them are in profit and 11 of them are in loss. We had to add another loser to that. It was 10, it's got up to 11. So the losers are catching up to the profiteers. We'll keep an eye on that. But we're still, on the whole, we're up. We're still better investors than we are not. I love our growth stocks. They're the ones that are going to make us lots of money in the long term, but there's something beautiful about the income generator and its guarantee to pay you dividends every month. We're now up to £17.87 for the year. That's up from £17.15 last week. And we've already locked in our payments of 2.43 in December, although that's creeping up, as you can see. And now adding to that, the ex-dividend date is coming up at the end of March, or sorry, towards the beginning of March. At the end of March, we're going to get paid out. It's up to 3.19, which means our payment after that, we're going to pay a subscriber £5.62. How's everything looking overall? Well, now we've added £600 to each of our 3 portfolios. It adds up so quickly. That would be my one encouragement to everyone watching this. Just keep going. The numbers add up before your very eyes. Last week, we were very pleased with ourselves. The Battle Royale had been performing at 10% total return. Income generator, a very smooth 4.1%. And I now confess, messed up the calculations for the benchmark. It was saying 15.4%. It was actually around 5. I've now fixed the calculations. And so for a better comparison this week, you can see the Battle Royale has fallen from its 10.8% high after such a bad week down to 7.8, which is ironic because the theme for this week is celebrating that 10% return, but that's the way it goes. Income generator flat. That's we're not worried about that, and the benchmark now a more accurate 5.2%. It is good in terms of security just to see that one kind of ticking over. And if anyone's thinking about investing and worried about it, as I was at the start not so long ago, sticking your money in a safe index fund, relatively safe. The markets fall as well, but that's just a steady accumulator, and I would encourage everyone to try it for themselves.
3, 2, 1, fight.
Do you want to be part of the 1%? Well, I'm afraid I can't help with that, but I can help with being part of the 10% yield. To celebrate the Battle Royale hitting its 10% return over 6 months of investing, our theme this week is finding 10% dividend yielding companies and trying to find the ones that make safe investments. Let's take a look at a few. I've really enjoyed researching this week's topic. It's great fun trying to find these massive dividend yield payers, especially when trying to find one that isn't risky, that isn't a dividend trap. I've looked at 3 and I'm going to immediately narrow it down to 2 because Delicate Logistics Partners, although it looks like a great company, is not purchasable through Trading 212, my broker. It might be available through your broker, so definitely have a look. It looks like a great company, 52% below Simply Wall Street's estimate of its fair value, and it also has a massive 11% dividend yield, tiny negative buyback yield, but that's not too bad. Its payout ratio is high, so do be careful of that to make sure that you think that it's going to be able to pay that dividend for a long time. Simply Wall Street highlights that its dividend is not well covered by earnings through free flat cash flows, so perhaps not the best one, but in any event, that's going to go. So we're now down to 2. Forgive my pronunciation for these. The first one's okay, Easterly Government Properties, DEA, great ticker. But the second one, Gulab, is that correct? I don't know, I'm sure someone will correct me. Gulab Capital, BDC. So the first is a REIT and the second is a business development company. The first is a really interesting REIT. It's a REIT for US government properties. So think about that what you will. The changes coming through from the Trump administration, reducing government employees is one thing to consider. However, they are pushing them all back into work, and so perhaps this business investing in those buildings isn't the worst in the world. It also invests in mission critical government agencies, as I understand it, so those buildings should be relatively safe. So I'm happy to continue to take a look at that. Our business development company, if you think about Main Street Capital, that's I think one of the most common ones, which is a great company, and this is along those lines, investing in debt and minority equity investments, also same as Main Street. It invests in middle market companies. The difference between it and Main Street, however, is that it has a massive 11.7% dividend yield, negligible buyback yield, which is great, huge payout ratio of 113%. However, there's no major worries about its ability to pay that and its cash flow. You would have to look into that if you were worried about it, of course, and that is one of the main things to be considering. However, if you're relatively confident that this can carry on paying out its 11% dividend for the near term, that's all you care about when you're buying one of these stocks. You want to make sure that it protects its value and that it continues to pay that dividend, so it's a safe place to park your money. So let's look into them into a little bit more detail. The valuation for GoLub is pretty good. Simply Wall Street thinks it's trading at 20% under its value. Its future growth, we're looking for it here just to remain steady. We don't think these massive dividend payers were going to dramatically increase in value. So as long as it's not decreasing in value, we're happy with that. And in this case, it's actually got an earnings per share growth rate of 5.2%. So that is fantastic. The dividend, the other thing we'd want to check is whether it's growing or decreasing. Are they going to cut it anytime soon? And in this case, it is increasing marginally. I'm not expecting this to go up, but at that sort of yield, I don't think you would. And comparing it to its direct competitor, in our case, this is a whopping 45.7% undervalued. But again, we're not too worried about the underlying growth as long as it's not going to be going down. But let's take a look at its dividend yield. Almost 10%. I had to round up a little bit with this one, thanks to Delac not being available, which did not help anything. But this does have a 4.7% dividend growth rate, which is fantastic to see, and a payout ratio which is a little bit more palatable, shall we say, of under 100%. So hopefully its cash flows will be able to maintain that dividend for a little bit longer. I did want to show you, when looking at the valuation, yes, it's undervalued, but its PE ratio is massive. It's 63.5%. And looking at its future growth, it's got a little bit more positive than its competitor in GoLab. So it depends what you think about that. So although it's undervalued, it is relatively more expensive based on that PE ratio. However, it's got slightly more potential for growth. Its dividend is slightly lower, however, and it's got a slightly higher or slightly lower negative buyback yield, which is definitely one thing to consider. So despite the fact that I thought these two were quite different and quite far apart initially, I actually think that these are really closely matched, and it's going to be difficult to decide. It would be up to you to decide whether you want to go all out for the higher dividend ratio and then dividend yield, and back it to carry on paying that, or whether you want a little bit more security, lower growth, or a little bit of growth as opposed to not much, and whether you think there's any future in government properties in the US. So, food for thought. Which one shall we pick? So there we have it, that's a wrap. What do you think? Please vote in your comments for who you think should win, and if you could also mention some of your other favourites, it would be very interesting to hear from you. From my perspective, I suggest we invest in... Although the markets have been flat the last couple of weeks, the days are starting to get longer and brighter and even a little bit warmer. So I hope that brings good news for everyone, and you have a fantastic week, and I look forward to seeing you again next week.
Goodbye.